Hi everyone, and welcome back to Finance at JCL, the show aimed to support beginner and intermediate level investors. And today what I've got for you is a discussion around the ultimate power of compound interest. So if we crack on, a quote that is often attributed to Einstein is that he said, compound interest is the eighth wonder of the world, he who understands it earns it, and he who doesn't pays it. And that's a very important principle to bear in mind as we move forward. So the compounding effect is the engine behind really successful long-term investing, and the way to think of it is kind of like interest on interest. So if you bought 100 shares at £1 each, so you put £100 in for a particular company or even a fund, and your interest rate or dividend from that was 5%, let's say, you would then receive £5, £100, and with that £5, rather than pocketing it, you'd actually chuck it back in and buy even more of that same stock or fund. So you'd end up with 105. Now the 5% of 105 for your second year is slightly higher, and then the slightly higher dividend or interest you get back from that, you'd buy more of your stock or fund. So you kind of start exponentially increasing by reinvesting the interest each year. So just to bring that to life a bit, I've got an example here at a 6% rate. So if you chucked £1,000 in, £1,000, your first year you get 60 quid in interest, second year you get 64, in the third year you get 67, and you can see it ticking up year by year until you get to year 30, which is a good long-term horizon. You're at £325, so just remember that figure, 325. So that's 5 times more interest per year than you're getting in year one. So that's pretty cool. So in a graph it looks like this. The white line is the value of your investment, and the orange line is the interest that you're getting each year. And you can see £1,000 turns into roughly £6,000 after 30 years, so that's pretty cool. But let's say we upped the ante a bit, just cranked it up, so let's go for a 12% rate, see if you can find that. A bit harder to find, but if you can, you'll see it's absolutely worth it. So £120 at year one in interest, you tick up to 134, 151, and by the time you get to year 30, you get an absolutely staggering 3,210 in interest. So you're getting 3 times as much in interest than the actual original amount you put in. And if you compare that to the 6% rate, you're actually 10 times higher with a rate that's only doubled. So that's pretty cool. So that's your blue line here. You end up with 30 grand from your £1,000, and your annual interest there you can see is the red line. So if you actually then put that back together with the original example, the real power is illustrated here. So your white line is 6% growth, blue line is 12%. And you can see it's absolutely smashing it, the blue line, just by doubling that rate. You're ending up with about 5 to 6 times more money. So what that tells us is that compounding effect is way more effective as your growth rate gets bigger. So in terms of investing, aim for those stocks and funds that will provide you with higher growth rates, be more selective, and you can take the time to be more selective because the long-term benefits are exponential, they're fantastic. And that kind of links into point 2 here, which is you really need to let this kick in over a period of time, because you can see after 10 years, the white and the blue are fairly close together. By the time you get to year 30, and it gets even bigger as you go further, there's a huge difference between the rates. So please do bear that in mind and consider that as you plan your investing strategy. So in terms of personal finance, so that's a key principle as well, because on your credit cards, the compound effect's working against you, so you want to pay that off quickly, ding that, because that's giving yourself a good rate of return just by paying it off, and then crack on with your investing and get it working for you. Now, for a bit more information, I do have another video around how to set up a budget, so I'll drop a link for that in the description below, and I hope you find that useful. But the key principle is the compound effect is cracking for long-term investors. So when it works for you, it's brilliant. The earlier you start, the better, and really do target those higher rates of return because it is worth it in the long run. So thanks very much for joining me today. I hope you found this a useful whistle-stop tour of the compound effect and how it can benefit investors. And if you do find this useful and you want to hear more, please hit the like button for this video. And I've got another 40 to 50 videos planned, so I'd really appreciate it if you hit the subscription button, and then you can be notified as the next tranche of videos comes out. Cool, so thanks very much for watching and have a great rest of the day.